Hello and good morning, nearing the afternoon. I want to begin this instructional video to let you know where we are in the markets. I teach this in my class regularly. This is what we should look at every week. You don't need to look at this day by day because the overall net effect takes days. And this is one of my first places to go. Here you are, it's the OEX A200R. It's a free chart available on stockcharts.com. I still use that, although there are similar charting representations on thinkorswim. I don't know why thinkorswim isn't showing here, but it's on the computer. What am I looking at here? Well, the way I have it set up, it's on daily. This is a representation of the percentage of stocks trading at price over their 200-day moving average. To explain this, it's very simple. The 200-day moving average of the S&P, which is the OEX, as an index, you cannot trade this. It's represented by the red line. The 50-day moving average of the OEX, 200-day average, is the 50-day is the blue line. And as you can see here, this price line moving up and down is not a price line. This is a percentage line. So the percentage of stocks in the OEX moving over their 200-day moving average is at 61%. The blue line, representing the faster line, I would rather see this over the red line and approaching the red line. So here's a representation using the MACD below it on the weekly basis. It hasn't been traveling over the blue line and over the red line since October, November. We've been on a decline. And you can see here by the MACD, the moving average convergence divergence, which gives a kind of a precognition as what would happen most likely over time since 2021. January, and you can see that dip in here, and this was February, middle of February, early March. We began to show a more radical decline in pricing. Of course, you know what happened. Elections have consequences, and this election has had a disastrous consequence. We are continually heading lower and lower. Now, I tell my traders that when this indicator, the Williams percent R, is in green, that is a good time to be long or buying, investing in stocks and other securities available in the markets. They're doing well. They were doing well. So that ended in February. We had a down move there, and only briefly did we have a green area here to buy and be investing, holding long, even though the market pricing may have held up a little while longer. So here we see an upward move coming out of 2020. Once again, expectation and late buying in the season, which is very common, and then selling. So the markets typically do sell off after Christmas and some before, and they unload to take a whole new tax season come January. Not unusual. This is the way it works. You have to understand how the market works. If you made money in the preceding years, you put that money aside. You take it out of the market at the end of the year. Just what you do. Back to the daily chart. And as you can see, since August, September, that's as far as this is going back right now, the number of stocks reaching their 200-day high, which is about 2/3 of the year, has been on the decline. Now I look at this as a clear barometer or bellwether which way to be traded. Should I be long or short? There are sectors that you can be long and hold, like energy, and you know we all know about the technicals, the tech stocks that have been in decline. Well, that's just the way it works. If you want to invest with success, then you need to learn to earn. And here, as you can see in this metric up here, the Williams percent R, had a very short week of buying. Another one here in November, and it's all down for the rest of the way. And as you see here, maybe a couple of days of buying here, and then just as the year began to turn here in December, we're up in this zone. We have shown some success. Some stocks had reached a high over their 50-day moving average of highs, and since then we've been moving down. We haven't changed. We had this black line is moving up. The black lines are moving up. That means the number of stocks trading above their 200-day moving average is moving up. But all in all, what we should see, what I would prefer to see, is that this percentage here, the 61, should be more upwards of 65 and increasing. I'd rather see this blue line moving closer to the 200-day line, and clearly the blue line, when it crosses over the 200-day, much like what you expect to see, the short line, the short moving average moving over the long-term moving average. No difference here. And as you can tell, we're not. And if I move over here to this screen, hopefully it's showing up today, I don't know. This is the S&P advancing issues minus declining issues and the difference. Down here is my own indicator. It indicates when the S&P is ready for a decline. And this is when the S&P inverses are ready for a decline. But that if the inverse is over the S&P, which is the green, green for go and red for no, all right? Green for go and red for no. When the red is on top of the green line, the S&P is in decline again. And this is the advancing issues minus the declining issues. Interesting how they kind of go together. So here you see the inverse ETF is on top of the S&P, and the issues are in decline. It's on top of the S&P Friday, part of Thursday, all of Friday, and then Monday again. We have advancing issues accelerating here on Monday, and then decline again. The S&P as an index moves up, but you notice how it quickly begins to slide back down again. So I don't trade off of this. You can't trade here, except it does give you a good picture of what's happening. Let's see, I'll move this to 1 hour, 20 days. Maybe this will make more sense. The green is the S&P. Double down arrows tells me to get out of the S&P. And here, marching upwards, last week ago, 2 Wednesdays ago, this is 1, 2, 3. This has moved this back 20 days. But by this observation, you can see where the S&P's inverse has moved up and over as of 10:30 in the morning. And sure enough, why was that? Because those in the know, the big money, the fast money, are paying attention. And here there's either shorting or selling going on. And from Thursday, actually Wednesday it began, and more issues are being sold off. Decliners are winning over the advancing issues. And then we have a few more advancing issues coming up, but the S&P now is in a conflagration. There's really no movement of the S&P in a steady up. You do have some advancing issues, very high, but once again taken down. This is why you see this market going up and down, because for all the advancing issues, as soon as they're raised up in price and volume, they're sold off again. Make a quick buck. But if you're consistent and persistent, as I can continue to remind people, here you see this. The red is over the green. Don't trade. When you see these inverse ETFs are in a dominant position. I didn't invent that to happen. That doesn't happen because the chart is moving that way. This is a reflection of what's happening inside the market. Here you see the S&P begin to move up, double green arrows here, and it starts to move up. It crosses over its inverse cousin, and what happens? We see by Tuesday, 12:30 in the morning, afternoon of this week, no, this is the new week here, of last week, it moves up, the S&P rises, and indication it's going to fall again, and so it does. All right, that's fairly simple, but you have to look, and you have to know where to look. So what is my opinion for this week? Well, we do have the number of declining issues has fallen. Well, so there are fewer decliners, but the S&P is not in that good a shape. Here you can see today, yesterday starting at 1530, I already had an indication, the double down arrow here, that this metric is moving down, and so it did due to the increasing number of declining issues. That's the kind of market we're in. It's being bought up, sold off, bought up, sold off. You have to be very careful. You take the profits when you can. I don't know what you all are trading. My advice is to use a whole lot of scrutiny. Go to the bellwether stocks or sectors of the market that hold up through this kind of I can't think of a word for it, but this kind of insanity, so to speak, and look for those things that produce those underlyings and stocks and ETFs and funds that produce income. That is my mantra anyway, is to trade for income, because when you do that, you're not going to walk away so empty-handed as holding on to big positions that eventually leave you high and dry when they fall, because they all do. So I'm not going to go into any other discussion on stocks until probably toward the end of the week. My advice is to be extremely careful. The S&P could rise today, and that would be great. So trade accordingly. If you're an option trader, trade some longer term chicken spreads, as they're called. Long calls and long puts on the same underlying. You can hold calls and you can hold puts on the S&P. One or the other makes money, take the profit off. Hopefully it swings far enough that you make money on both sides, or one side enough that you can still have a profit at the end of the week. Take care.